Welcome back to Everything Money. If you're watching all over the world, we welcome you in. It's Seth, Paul, and Mo, as always, talking about stocks. Today we talk about Amazon, this colossal company. Paul, you and I love Amazon. It's gotten to the point, you want to talk about a moat. I mean, it's gotten to the point where, like, if I want to get anything, damn near, I just, like, 3 swipes of a phone later, it's like arriving at my door within a couple days. I mean, it's just absolutely
the funny part
incredible.
is the other day I ordered something and I canceled it because I was already out and about. I was like, I'm just going to go pick it up from the store. I mean, that's a very rare occurrence, but I was just like, you know what, I kind of want it today. It was something for a cleaning supply for my house, and I was just like, you know what, I'm just going to go pick it up now.
This company seems unbeatable. I mean, the stock price has soared in the past year, obviously due to COVID. But now, Paul, last week it got beaten up a little bit, and we want to reebvaluate.
Why did it get beaten up?
Yeah, well, I don't know.
Well, let's go look at the news in our trusty Everything Money software.
Go ahead.
Let's see.
Amazon Q1 earnings call.
They top line falls short of estimates. That's the revenue number fell short of their estimates. So even though they did very well, and I think they crushed earnings.
Yeah, they did.
Their revenue came in lower than expected. Why are you smiling, Mo?
I think they missed by it was like 115 billion expected versus they came in at 113 or something like that.
Yeah.
That's what happens.
Yeah, and I remember we were laughing about it the day that it happened.
Well, that's what happens though, guys. It's insane to even think.
Yeah, it is.
And this is what I don't like about U.S. stocks. I think the European markets, they're much more interested in the long term, which is why we don't always get quarterly results from European companies.
Yeah.
U.S. is all about next quarter. Next quarter. Yep. It's like, guys, imagine if you're a CEO trying to allocate capital that might pay out. I mean, look at our company. We invest money into something that might take 3 or 4 or 5 years to pay out.
Yeah.
You can't do that as a publicly traded company as well. Now, Warren Buffett's done a good job of managing expectations, doing things like that. But here, it's about what are you doing for me this quarter? Yep. So let's look at Amazon, see where it stands. $1.7 trillion market cap, guys.
Jeez, always.
$400 billion in revenue. PE of 62. That's an X. Yep. Profit margin of 6.4. That's an X.
Good boy.
Guys, their gross margin is only 25%.
When you say only, give to me in like stupid person terms like me.
Well, look at software. People tell me it's not a retail business. Well, guess what Walmart's gross margin is? 25%.
Oh.
So I look at this saying, guys, Amazon does have Amazon Web Services. Very high margin, but also very competitive market. Google, Microsoft, Oracle, they're all in the space and they're all growing like crazy. This company still derives most of its revenue from the retail section of their company. If you look at their 10K, it'll tell you exactly how much is there, but it's only 25%, nothing huge. Now, their return on assets is okay, 9.1%. Now, do I expect that as time goes on, this 6.4% margin will increase? Yes, because as they do more technology-related things and Amazon Prime, in terms of the video, the Prime Video, things like that, I imagine their revenues, their profit margin will increase. But is it going to 20-25%? No, I do not think so.
How about revenue growth over the past 5 years?
Yeah, huge. 140 to 420. Look at last year. Went from 300 to 420. Why? COVID. Nobody's allowed to go to stores. Guess what Amazon did? They're like, hey, buy from us. Mm-hmm. So, hey, Mo, can you do me a favor? Can you find out how much of their $419 billion in revenue was from selling retail?
Sure.
Pillar number 4 is profit growth over the past 5 years.
Jesus H. Christ. 2.6 to 27 billion.
Oh my God.
Yeah, I mean, it's huge. And look at last year. 10.5 to $27 billion. COVID. All right, shares outstanding. Well, 477 to 504. That's an X. And look at 10 years ago, they had 450. So they're up over 10% number of shares they're giving out to their investors. They have out to the market over the last 10 years. That's only diluting you. It's a silent killer. Nobody really pays attention to this, but you need to, because if a company doubles its revenue and profit, but also doubles its shares outstanding, not a stock split, actually issues more shares, you've gotten no benefit out of it. So a company diluting you is hurting you even if the company is growing. You're not going to grow as much with it. Okay?
If these numbers resonate with you, you can have access to this software. I know I'm you guys out there. I had a hard time investing for a long time. I watched ticker prices. I listened to my friends who had no idea what they were talking about. Our show is based around looking at the fundamentals behind this company, and you can do this by getting this software. The software is incredible. We set it up for you, and as a part of our Patreon, you click the link below. You can have the software, all these amazing tools we set up for you, and Paul's going to talk about it right now.
Guys, we have a mobile app. None of these guys have a mobile app. 8 pillars, 30 years of financial data, stock analyzer tool, all these things. Exclusive daily content only for people who are part of the mobile app and the software. Discord community, 4,500 people in there you can talk to about your investment ideas. Even crypto, even though I'm anti-crypto, even though I'm anti-Tesla, they'll still talk about it. It is currently $26 a month. That is 85 cents a day. 85 cents a day is less than a crappy cup of coffee that you buy from your local gas station versus $200 a month, $235. Guys, this is a no-brainer. If you're serious about money, if you're serious about investing, sign up now because you will be locked in at your 85 cents a day for the rest of the time.
Let's look at pillar number 6, which is current assets over current liabilities, Paul.
Okay, so current assets is 121 billion. That's cash and cash equivalents. Current liabilities, 115 billion. So they have enough to pay off their current liabilities.
Free cash flow is the big mamma jamma.
Yeah. They went from 8.76 billion to 22 billion. Wow. I'm actually surprised it's not more because Seth, their revenue went from 140 billion to 420 billion, yet their free cash flow only went up 2.5 times. So the revenue tripled, but their free cash flow, oh, actually it's not that bad. It's 2.5. It still should be higher.
Yeah.
With a higher gross margin, it should be higher. Average of 15 billion, 15 times 20 is a $300 billion market cap.
It's 1.7
It's currently
trillion.
at 1.65 trillion. This screams overpriced. Does that mean it's overpriced? No. After Mo's done with this chart, we will put it in the stock analyzer tool. The stock analyzer tool, by the way, if you look at the 8 pillars here as a recap, this tells you all the 8 pillars of the company. Obviously, valuations are bad. They're selling for 110 times free cash flow. We'll put it in the stock analyzer tool and account for revenue growth, even though it's a huge company, to see what we should pay for the stock.
Mo, I know the bid and ask was all fired up with this drop last week. What's going on with Amazon over there?
So actually, if you go out a year, this is similar to the chart we just looked at AMD. Granted, they're swinging between 3,000 and 3,500, but they're in that consolidation area. They tried to peak out there for a little bit, and then they got hit on earnings. So why don't we zoom into that, look at this, what is now a breakaway pattern, which is not the greatest thing, but it's Amazon, so maybe it's different. You did have that gap down, perfect downtrend happening right now. This is a tough stock for me to short, just because there's a lot of people that are always buying Amazon. And I like to go based on patterns, but when it comes to things like this, in a market that is not falling apart yet, that's when I struggle. But let's look at how powerful these moving averages are just for the time being. This thing gapped down and just fell right on top of its 100-day moving average, and it basically is just hovering right there. So when I talk about these 100-day moving averages, and I always say the hedge funds make their decision of whether they're going to go long, short, whatever, hedge funds are going to probably participate in Amazon because they see it as you got to put people in it. So to me, this is one that I'm going to wait until the trend turns back up, and I would go long on this, see if they can break out, fill that gap up, and go from there.
Paul, remember when Amazon made up most of my portfolio? I had like 90 shares of this, and I sold off many years ago. And obviously I missed this huge run up, but what I've really gained is a more disciplined perspective on how I'm going to invest for the next 50 years of my life, which I'm really looking forward to. But
Absolutely.
we can use this stock analyzer tool to help us come up with a price. We obviously, it's sounding like Amazon is obviously drastically overvalued at the moment. What should we be paying for this?
So guys, I always look at a 7-year analysis, especially with large companies like Amazon, because Amazon's going to be around for a very, very long time, right? So you have to decide yourself what revenue growth numbers you can assume. Now, to keep it in perspective, they did $420 billion last year in revenue. I'm assuming low of 15%, high of 25% annual growth in their revenue. So what does that mean, guys? That means in 7 years, the low side is the company is doing $1.1 trillion in revenue. That's a lot. That's almost tripling. And if you do 25% growth over the next 7 years, you're talking about $2 trillion in revenue. Now, this is where the world of investing, people don't understand. This is why financial planners can get away with getting crappy returns because people don't realize it. Over long, long periods of time, 6 or 7% a year can add up to 20, 30 times your money. But what they don't realize is 15, 20, 25% growth over a short period of time, especially with a company of Amazon's size, can lead to big, big money. Is it reasonable to say, on the low side, that Amazon will be a 1.2 trillion revenue company in the next 7 years? Boy, that just seems hard for me to understand. That just seems very, very difficult for me to understand. Even though their last 10 years are 26% growth a year, as you get larger and larger, it's harder to grow at higher rates of return. I'm actually going to change this to 10, 15, and 20% growth rates. Share change, they're still issuing shares. Profit margin, I'm assuming 5 to 8%, Because I do think as they get larger and larger, they're going to have to cut their margin. I think the big money maker, the big margin maker is AWS. It's more and more competitive as time goes on. That's a huge margin. It's going to have to get cut at some point as more and more people enter. Free cash flow as a percentage of revenue. PE. Now, I'm going to get so many arguments. 62, Paul, it's 62 now. Why are you assuming 13, 15, 17? For the same, how do I say it? Idiots who tell me that you should pay a higher PE because they're growing. As they get larger and larger and larger, what do you do with the PE?
It's harder and harder to grow. I mean, the PE
so you
has
have to pay
down.
A lower PE.
Yeah.
I do think 13, 15, 17 multiple of earnings and free cash flow is reasonable. And I'm putting 15, 12.5, and 10% as my return requirements.
This is going to get ugly here, Paul. Ugly. Oh,
guys,
not too bad.
I look at so the stock's currently at 3,300. Low side, 600. High side, 2,700. So if you believe Amazon is going to grow at 20% a year, it's going to have 7% margins, it's going to sell for a 17 PE, it's still overpriced based on today. Mm-hmm. Now, if you tell me, Paul, you're crazy, they're going to go 25 or 30% a year, then you're assuming that the company's going to be doing revenue of $2 trillion in a mere 7 years. That's a big jump for a company as large as Amazon. Is it possible? Sure. Is it probable? As an investor, I just don't believe it's probable. I have said for a long time that Amazon's overpriced. I've been wrong for a long time because the fundamentals keep getting better. But as of today, right now, I do think Amazon is worth in between 600 and 1,200. I've said 800 to 1,000 for a while now. That's where my value is in Amazon. Am I being too conservative? Perhaps. But as you read more and more about good investors who've stood the test of time,
yes,
their biggest thing is avoid the big downside risk. Paying $3,300 a share for Amazon has huge downside risk because a stock in the long run is going to go based on what's behind it. And the same logic you give as to why it should sell for a high PE, it will not be able to do so for Amazon because it'll be a much larger company that can't grow as much. That's just the reality of it, guys. Now, the world is growing, becoming more economical, not more economical. We get more and more middle class growing and growing and growing, but they have to expand worldwide, just like Walmart did. It's just, I just find this whole story to be very, very difficult to justify the prices at today. But again, I've been wrong for a long time, so maybe I'll continue to be wrong. I just choose not to have Amazon in my portfolio.
It's not shocking we would want to avoid something at this high of a price in terms of buy low, sell high.
Yeah, but that's always a misunderstood term. Buy low to me is buy a low valued stock relative to price, and then sell it when it's high the price is way too high relative to the value.
Sure.
That's the point of buy low, sell high, not just buy because the ticker symbol. Like if this stock fell 20% tomorrow, people would be like, oh my God, it's a screaming deal. I still think it's overpriced.
Yeah, still overpriced. Yeah.
Still overpriced. This is why the NASDAQ in 2000 fell 83% from its peak to its low, because things were so overpriced, the pendulum had to swing to the other side of the market. The same will happen today. There'll be a time in the future, mark my words, well, I'll be a big advocate of Amazon stock. And people out there will say, it's dead, you're stupid, Paul, I can't believe this. The same people will tell me it's going to the moon today. I don't know what to tell you. If this doesn't make sense to you, don't waste your time watching our channel. This does make sense to you, even in the sense of like, oh, I never thought of it that way. Mm-hmm. That sounds interesting. Stick around. Subscribe. I mean, this is just, to me, this is natural for me. A stock, any investment is worth the present value of all its future cash flow, depending on the return you want to make. If you're okay owning Amazon at 5% return, the stock's going to skyrocket in price. Oh my God, even a 5% return, it only has one price that works. Guys, I lowered my return to 5% a year. So at the current price, to get it to zero, to get it to the middle number, oh my, guys, even a 2% return for the next 7 years,
oh boy, you
still have to pay less than the current mid assumptions. That's how overpriced this is. It's just math, guys. If I were to tell you I'm going to give you $1 a year for the rest of your life, that's worth something to you today. You have to decide how much that's worth to you. Is it worth $1? Well, heck yeah, you can get your money back in 1 year. Is it worth $1,000? No, because you're probably only going to live 60 or 70 more years on the high side. You're not willing to pay $1,000 to get $1 a year for the rest of your life. That's the point of investing. But we buy into the story of it's exciting, it's growing. Every great investor of all time, please read Richer, Wiser, Happier, because it's so good. Every investor is so consistent. Every value investor just says, listen, I just look at it and during euphoric times when people don't see any possible losses, that's the most dangerous time. That's where we're at right now. Right now, the market psychology is everybody and their mother is a stock market genius, investment genius. It's just not possible.
That's a take on Amazon. Follow along with the videos. Join the Patreon below. We'll see you in the Discord, and we'll see you on our live streams. Thanks for watching. Oh, and follow that thumbs up on the way out thing. You know how to do that.